Howdy there, folks. Welcome into today's video. It's a buy one, get one free here today. Two videos for me to react to. First one up here, we're starting to see a little bit of pain in the stock market, in equity markets. I want to share my perspective and opinion here, what this gentleman has to say in regards to this one. Second video I want to react to is you have to be careful with Apple stock with interest rates elevated. I want to hear what this gentleman has to say. I think this can go deeper than just Apple stock and interest rates and these sorts of things. So I want to hear what he has to say and kind of share my perspectives and opinions in this one. By the way, I've been slacking on content a little bit on this channel. I think I've been putting out a little more videos on the main channel, but not to worry. Got a lot of videos coming for you guys over the weekend. Got some interesting videos to react to. I'm seeing a lot of interesting content out there. So, by the way, beautiful day here in Vegas here today. It is. We actually had a little nice downpour for about 10-20 minutes there here in Summerlin. So, man, I always appreciate that. I know 10-20 minutes doesn't sound like a lot, but in Vegas, if it rains for 10-20 minutes, pretty good. Like, we'll take that, okay? Any bit of rain we can get, we love it. Two things for you guys before we get into this. The first one up here is, this will be the first link in the description down there. I put together a watch list of my hedges, of my potential hedges for 2024. That will be first link in the description down there. If you want access to that, I can email it over. So I'm sure a lot of people are interested in that. And second thing is I made 4 buys in my Patreon portfolio here today. If you'd like to see all the stocks I'm buying, selling each and every week, then check out the pinned comment down there. That will be to join us in my Patreon over there and get to see all the moves I'm making in the Patreon portfolio. So that will be pinned comment down there. Alrighty, guys, let's get into this.
Landsberg Bennett, Private Wealth Management Chief Investment Officer. Michael, great to have you with us. How do you view this rise in bond yields? It seems like whenever bond yields tick higher, 10-year in particular, we see a headwind for stocks. Is that something that you continue to be concerned about, or do you think the 10-year is sort of going to see its peak soon?
Listen, I think the 10-year can go a little higher. I mean, typically the bond market has always kind of led the stock market. And I think, we've expected the Fed to continue to raise rates. I don't see really a reason why it doesn't continue to go higher. Now, I'm not saying it's going to be 6 or 7%, but I think where we are now, we're starting to see a little bit of pain in the equity markets. But I think that could continue for a little while as rates push higher and they're more competitive for people's dollars.
You're recommending investors cycle out of tech. I mean, we've seen that sort of cycling out of the biggest tech companies already with, Microsoft down 15% or so from its peaks, Apple down about 10%. Where do you put that money?
It's typically a process that we do.
You know what scares me a little bit? This scares me a little bit this scares me, man. Because, like, that gentleman just said, not expecting 6-7% rates, right? 5%, okay. And even Jamie Dimon, some bears have talked about 5%, but no one's really even considered 6 or 7. This is something that scares me. Because I'm like, what if some of these treasuries do go to 6 to 7%? Then what are we looking at? Because no one's expecting that. Bulls or bears, right? And so I always try to think about, like, what is no one expecting that is a potential? And it's not crazy to get to a 6 or 7% number. So that's something I'm thinking about out there that I'm a little concerned. I mean, there's a lot of things I'm concerned with over this next 18 months. I'll just be completely honest. But it's just one of many things I'm definitely very concerned with.
Obviously, last year, tech down so much. Made a lot of sense to kind of add back to it in January. And conversely, July, we took some money off the table in some of those bigger names, NVIDIA, Amazon. We're going to look for the ones that are growing earnings. I mean, this earnings season's not been great. I think we're down 8% year over year in S&P 500 earnings, but there are companies that are growing earnings. United Health Group growing earnings, McDonald's growing earnings, Diageo as well, in Lockheed Martin. So we're looking for the names that are growing earnings that just haven't had the multiple expansion that tech has had. Because realistically, the tech expansion has been great. I mean, those 7 names are up, I think, on average, 80 some odd %. It makes sense to take some money off the table. Not to get out of tech, but when a name like NVIDIA goes from 4% of a portfolio to 9 or 10, it makes sense to cut it back.
How do you answer the valuation question? I mean, you like a McDonald's, for instance, which is trading at about 24 times forward. Take a look at Meta. It's trading at 21 times forward.
Oh.
Some people might say, that's a sort of an interesting choice to make, to choose McDonald's over a Meta.
Yeah, and again, I think that's a valid point. Meta is actually probably the one that's not crazily multiple-wise in this environment. But part of it's just the fact that Meta's had such a big move. We want to rebalance and trim back. So if Meta's 3% of our portfolio, it got to almost 6%, we're going to take it back a little bit. Doesn't mean I don't like Meta, But when you've had a big move like that and you haven't, had a move like that in McDonald's, it makes sense for us to trim a little bit back.
It's just such a flawed way of thinking. Guys, don't ever fall into that trap, okay? It's just a horrible, horrible way of thinking. Oh, this stock's gone up a lot. This stock hasn't gone up, so therefore I need to put money in the stock that hasn't gone up. No, okay? You got to look at the valuations. You got to look at growth rates. You got to say, okay, where's my better risk-reward profile, okay? If you're overexposed to a position, then you can say, okay, maybe I shouldn't buy any more of the stock because I have too much in my portfolio already, and if it goes bad, right? That's not what this gentleman's saying at all. He's basically just saying, oh, one stock's done really good, this stock hasn't done that much, so I need to put money over here. It's just a flawed way of thinking. If you're buying McDonald's over Meta right now, I don't know what to tell you, man. Like, you just, a little lost, a little lost in regards to understanding the market, understanding valuations, understanding, what stocks are going to perform the best over the next 5-10 years. Like, it's just an extremely flawed way of thinking. So please, don't ever fall into that trap, because that's just a money-losing trap there.
At the end of the day, we're in the risk management business. And when a stock is, more than double like Meta has in 6 months, we thought it made sense to take some of that money off the table, allocate it to something that is high quality growth,
right?
Just a little bit more defensive.
You're also recommending that people look abroad, India, Brazil, Japan. And I'm wondering how you factor in what's going on in China, whether it be Zhongrong International failing to make payments, Evergrande's, bankruptcy, reorganization, all these different factors hitting the Chinese economy.
Yeah, we actually would be short China. China's not a name or an area that we like. We think they're obviously entering at least an industrial recession.
But no spillover into Latin America, India, and Japan?
Yeah, we do we like Japan. For example, Japan just had a 6%, GDP, increase. And we see India having some forward momentum as well. And they're not fighting a federal, a central bank that's raising rates. That's one of the big issues that we see. And there's some spots in Brazil as well that are going to have a couple good quarters in a row and not have the specter of raising, rates into their face, which, as you know, that's tough. It's tough for the U.S. economy at some point here to continue to move higher when rates have been pushed so high. I mean, we saw 20-year highs yesterday in the 30-year mortgage. It's going to affect the economy in the United States, and you're not having that problem in some of these other overseas markets.
Michael, thanks. Have a great weekend.
True.
You too, Melissa.
Yeah, good point
All
there.
right, final check on the markets. I mean, for today. Hopefully it's not
final.
Yeah,
forever.
I know. It sounds so final. We're down 165 points now. But
You never know. That's why you should value and treasure every day that you have.
Wow, that was special. Okay, so before we get into this Apple one, talking about interest rates and kind of growth stocks in here, let's just see what we're looking at in terms of moves for stocks here today. So it looks like it was a bit of a recovery as the trading day kind of went on here today, right? Palantir looks the most green of any stock. Wait, Palantir? Wait, there's no way. Oh, wait, that's not a one-day chart. I'm like, there's no way Palantir opened like that. Yeah, Palantir just kind of shifted up as the day went on. Let's see PayPal. PayPal kind of similar. Yeah. Strange. Corsair. Foot Locker. Yep. Target. Yeah, it seems like just things kind of opened at the lows, and then they seem to just kind of have improved moderately as the day went along. See a stock that was red today. Even Meta, a stock that was red today. It was kind of hit those lows in the first 30 minutes to an hour of trading, and then kind of went up from there. And a lot of times I like to make my moves early in the morning. Now, I'm not awake for that because, I stay up super late at night, looking into companies and listening to conference calls and all that stuff. But I like to place my orders sometimes the night before, and usually those orders are placed within the first 10 to 15 minutes of market open. And a day like today is a pretty good example of getting a little better pricing early morning versus what you'd get later in the afternoon.
Rates make it, quote, tough to argue for multiple expansion, and that is a key driver for names like Apple. Let's bring in Barton Crockett, Rosenblatt Securities Analyst. He downgraded Apple to a hold recently with a target of 198. Barton, it's great to have you. Do you think the relationship to rates...
By the way, and just to explain the Apple dilemma, that's for the whole stock market. Just to be quite frank, this is way bigger than just Apple. The Apple dilemma going on here is we have the most important stock in the stock market in terms of market capitalization, right? And in terms of stock that people own. Like Apple's the most over-owned stock in the world, right? We have a company literally that has their revenues going down right now. It has one of the richest valuations it's had on it in the past 10 to 15 years, especially in the past 10 years. And that's not a very good setup. And we don't know when the revenues recover. If they recover, one. Two, if they do recover, we don't know when that's going to be. Like, are we looking at, a few quarters from now? Are we looking for a year from now, 2 years from now, 3 years from now? That's the problem. We don't know when those revenues start to tick up again for Apple. Like, we could be in a weaker spot for Apple's revenues for quite a while. And that caused a problem for the whole market because of how big Apple's weighting is, obviously, in the market. It's the most over-owned stock in the entire stock market.
Between rates and Apple is the most important name in evaluating the stock?
Well, I think it's certainly important because, what you have with some other tech stocks that we favor is meaningful growth. You have margin improvement at Amazon, margin improvement at Meta, and great top line. At Apple, you don't have that level of kind of reset to the margins, and you don't have that level of kind of top line. The stock has been a great performer, and that's been really propelled by valuation, which now at recently close to a 30 PE, about 1.5 times the S&P 500 is at peak absolute and relative levels. I think that's been a great driver. It's hard to say that you want to bank on more of that from here.
All right. We were looking at the chart, the 2-year chart earlier this morning, and wondering whether or not these levels around 170, 180 are support, whereas they were resistance in late 22.
They could be. I'm not going to go too far into the technicals because I focus more on the fundamentals. But and I'm not negative on Apple. I've got a neutral rating at this point. But I think you've got to be careful. Without kind of the great kind of earnings revenue reset that we see at some other companies, and with inflation rising, which I think, or with the interest rates higher, which I think is a headwind for the multiple, it's hard to say that this stock is going to be an outperformer like it has been going forward.
Barton, where else do you think, you mentioned a couple of other names that you think have growth. Are you seeing enough differentiation in terms of, investors?
Before he gets into kind of some stocks he sees opportunities in right now and things like that, here's a main issue for Apple stock right now, outside of, what I mentioned previously, okay? You got to always think about who are you going to attract for a shareholder base. You've got to attract a certain group that looks at that and they say, okay, this is a great place to put my money. Here's a problem with Apple. Are they going to attract a growth investor base right now? Or a bunch of growth investors going to go buy Apple stock over this next, let's just say 6 to 12 months. Okay, let's not talk about the next 5 years, 10 years, just the next 6 to 12 months. Are growth investors going to go buy Apple stock? The answer to that is absolutely not. This is not even something that, what are we doing? Okay, we're going to switch. What? Like what? What are we doing here? Come on, man. I don't want this. Can't we just go back to me? No, not switch photo. Come back to me. Whatever. You guys aren't going to be able to see me for the rest of this video. All right. What? That looks weird. Damn it. This sucks. Are you freaking kidding me? Am I going to really have to go in that house? Oh, my goodness. This is unbelievable. Oh, my gosh. Hey, I need to record the rest of this video in the house. It's going to be like 5 minutes or so. Oh, and I'm wearing short shorts, too. Are you kidding me? Just phenomenal. It's freaking great. I'm recording a video. So, back to what the issue is with Apple. Are growth investors going to buy Apple stock? And the answer to that is no. There's no growth. Are value investors going to flood to Apple stock? Well, not really, because Apple's not really trading as a value. Are dividend investors going to flood to Apple stock? No, because at the end of the day, if you think about the dividend yield on Apple's a complete joke. So you're not going to attract growth investors, values, or dividend investors. Or are you going to attract the people that are looking for a flight to safety over this next 6 to 12 months? Not really either. Because those people look out there and they say, well, I could risk my money in Apple, a company that trades at a very high PE with revenues that are downtrending, or I can put my money in a treasury and get 5% guaranteed. I can put my money in a savings account or a CD account and get 4 to 5% guaranteed, right? That's FDIC insured money. And so that's where the issue comes in for a stock like Apple, and you just kind of look out there over the next 6 to 12 months, and it's like until they get their revenues back uptrending again, that stock's just going to remain in a pretty tough place.
Kind of migrating toward the growth stories. We were, used for a little while to people considering this. 7 or 8 stocks as a block?
Yeah. Look, I do think that there's separation in the tech group broadly. So I think you have a group of companies that are benefiting from, basically a reset of costs that got way out of whack into the pandemic. And we're seeing that really kind of propel margins forward, that people like Amazon, people like Meta, people like Pinterest, and we've recently kind of moved in to more constructive ratings on Amazon and on Pinterest. So we like that story. We do think that the macro is healthy enough that we're supporting a good ad market, particularly those on the secularly, favored side of the divide, the more kind of internet stories. And we're also seeing a consumer that can spend, which is helpful for certainly retail at Amazon, and helpful, I think, for cloud services, which are also getting, over time, I think, a benefit from AI. So there are opportunities, there's growth stories, there's margin stories. We favor those versus just banking on multiple reset, which has been the story at Apple.
Do you think of Apple?
Yeah, Meta is really the perfect stock right now because you're getting growth in revenues, pretty strong revenues expected in the back half of the year. You're getting growth in margins and obviously growth in profitability in quite a substantial way, while also paying a very cheap forward P. Forward P in the stock's 20 to 22 range, depending upon kind of what you have Meta doing for numbers next year, right? It puts it at a sweet spot because Apple trades at a much richer valuation with a shrinking revenues and, could be shrinking everything coming up here, right? You have Amazon, which I love Amazon. I am an Amazon shareholder, but the problem with Amazon, you look at the forward P and it trades very, very elevated, right? So that's where Meta's just at a very, very sweet spot right now. Google's in a pretty decent spot as well. The one issue for Google McDougal is they have some government issues, government looking into them, things like that they're dealing with, and potentially some big legal fees. And also that's just a cloud that kind of overhangs Google here in the short term.
As a high multiple tech stock that sells off during times when yields are going up, like we've seen, or is it more a consumer staple bond like to own during tough times, or maybe they both go together? But how do you think about the right multiple and what kind of environment works best for Apple?
Look, I'm not saying that Apple's multiple retrenches. I think it's appropriate for them to be valued like a premium, consumer products company that people will buy these devices when times are tough. And I just don't have the call today that we're facing tough times. The macro has been more healthy than I expected, into this year. And today continues to be more healthy. If we were to go into an environment where the macro is less healthy and growth is harder to come by, maybe you cling tighter to those names that are just kind of comfort food, like an Apple. But today we don't see that. Today we see margin and growth opportunities that are more interesting in the space.
We should talk about those another time, Barton. Really good stuff. Appreciate it on this Friday. See you soon.
Yeah, so the issue also there with Apple is Apple obviously, a lot of people buy Apple products that don't really need a new phone. It's not like it's just people that, I broke my phone, I got to go buy a new one. I broke my iPad, right? It's always, for Apple's business, always been a huge base of people that are essentially like, I want to have the newest, latest, and greatest, whatever, right? iPhone, iPad, MacBook, whatever. So obviously, if we're talking about a weaker economic environment, consumers been sliced and diced with inflation, that obviously puts some pressure on Apple, which is what we're seeing, just to be quite frank, from Apple's business, and that's why their revenues are kind of where they're at right now. So, yeah. Appreciate everybody joining me as always. Thanks so much for being subscribed, folks. New all-time high subscribers in the history of the channel. Appreciate y'all. First link in the description down there if you want to get my hedges watch list and kind of what I'm looking for there. Check that out. And then if you want to join my Patreon, see the moves I made here today. I bought 4 stocks, and including the moves I make in the future. Then check out the pinned comment down there. Much love and have a great day.